Welcome to this week's edition of Navigating the Markets with me, Markets and Mayhem, coming to you live September 9th, 2024. And it's been a pretty interesting day. First, let's get through the risk disclosure. All trades and investments involve the risk of financial loss. The value of positions can go down as well as up. Past performance does not guarantee, nor does it predict future results. All right, so let's go through some of the technicals here real quick with the S&P 500 in mind. First, we can see that we had an inside day here. We tested this low volume node on Friday. We got a bounce from there. We continued that bounce into today, but I'm not so sure we can say that we're out of the woods quite yet. So if we zoom in on some of these pivot levels, I do want to see us push above this 54.9450 level. I would be bullish above that level. I would also be looking for fades below 54.76 on ES. So bullish above 54.9450, bearish below 54.76. And if you want to take a screenshot of this, save it for later to have the levels of support and resistance, you're welcome to do so. Moving on, we've got the gamma flip levels here on screen. We're just almost 100 points into negative gamma territory, probably quite a bit less now that we've closed out the day closer to the highs here. So probably closer to about 50 points into negative gamma, 60 points. Still have to look at this as an environment where we have elevated volatility risk and some degree of elevated downside risk, as negative gamma tends to increase the chance of buying rips and selling dips from dealers and the way they're hedging. On the other side of that, it also is back tested to be more likely to be in sort of a corrective impulse or downward trending environment. Now below us, we have decent options implied support at 5,400 and 5,500. Of course, above us on SPX is a pretty big area of options implied resistance to watch. We also saw skew coming off today, dropping down as we saw some of those hedges being taken off, and as we also saw S&P puts losing value ahead of next week's options expiration. That was one reason we had constructive flows, especially in the first hour of the day, as well as some of that volatility involved therewith, as we saw some larger trading desks fade those flows. They got a decent trade out of that, but we did see a reversal higher and indeed into the end of the day. We also saw the put call ratio for equities come off some of those extreme bearish levels that we saw on Thursday of last week into today. So we're no longer in fear territory based on equity options volume. If we look at the number of stocks above the New York Stock Exchange 20-day moving average across the composite, we're just about in the neutral zone here. We're no longer overbought, and we're certainly not close to oversold, even after last week being the worst week in about 18 months for the broader market. Now, if we look at this as a one-day heat map, it looks like we see a lot more money going into most of big tech outside of Apple and Google. Apple's event not necessarily really received well today. But if you zoom out a week on the heat map, you can see the last week, even including today's trading action, didn't really reverse a lot of the sort of red we saw in tech. So even though today was a decent day for tech, there's still over the last 5 trading days been a lot of bloodshed there. And you can see there's been that rotation into more defensive stocks over the same period of time. And this is a bit of a theme that I think may be set to continue. So we look at staples, utilities, healthcare, even some areas of real estate have been doing well. Now let's zoom this out to a month heat map, and we can see even in that month that there has been this rotation out of larger tech for the most part and into other areas of the market. Tesla and Amazon being exceptions to that rule, but you can see even rotation into smaller tech companies, comparatively speaking, like Oracle, Adobe, Palo Alto, Fortinet during that same time. And you can also see in rotation into the broader S&P 500, the inglorious 493 starting to catch a bid. And that's one of the swing trades that we've talked about. So first, let's get through SPLV, SPHV. This is the low vol versus high beta swing trade. We can see that it's having a pretty good run since we started talking about putting it on in later July as that relative strength started to really increase. And this is continuing here. In fact, it's hitting new highs recently. I think that this one has some ways to go, and this is part of a broader rotational theme away from the really high risk parts of the market and into some of the safer havens. Similarly, we can look at the S&P large cap high dividend ETF versus SPY. Also, last week hit new relative strength highs on the pair trade of long SPHD versus short SPY. And this is one that I also think has some room to go, although we can consolidate a bit here as we process some of these gains. I do think as we get into the later part of September and in all the way through the mid part of October, that this trade could continue running higher as well. And then we have RSP versus SPY. This trade is all about that idea of relative strength in the equal weight and some degree of relative weakness in the market cap weighted. You can see it hasn't done quite as well as some of these other pair trades, but I think this rotational dynamic will be set to continue for some time to come. Then we have IWD versus IWF. This is value versus growth on the large caps. This one is another one that I'm pretty bullish on because I think that we do have a time and room for a broader rotation into value and away from growth as we start to see the economy slow and as we see there's more interest in companies that have clean balance sheets, strong free cash flow, and the ability to be more resilient during an economic downturn. And then last but not least, we have small cap IWN value versus IWL small cap growth. And this is another one where I think we may have some room to continue, although it may consolidate near term. I think that rotational theme of the value part of small caps versus growth, where about, most of the Russell that doesn't make money is growth. It's about 40% of the Russell that doesn't make money. And I think in this environment, those companies in a slowing economy where we still have relatively high rates, even after the Fed's cutting cycle, could be somewhat disadvantaged. Then we have DigitalOcean here. This is a swing trade we talked about. It's really starting to break out. I love seeing the strength of this thing, especially as the market's been rolling over. The way that this has been rallying tells me there is some room to continue, that there are some larger institutions buying, and we're pushing decisively above this yearly point of control, which has me thinking we could start to make new 52-week highs in not too long. But I am looking for this one to get to about 48. That's where I'd be taking off my core. And so far, so good. Now, here's an interesting two-way trade setup. This is HubSpot. If it's able to hold this trend line, I think we could get a bounce to the top of the trend channel, perhaps to around 750, 800. We'll see where that bounce occurs, if it should play out. On the other side, if it breaks this trend channel and the point of control, I think we could get pulled all the way down to about $300 a share. So this one is a big two-way trade. Recall Google wanted to buy them earlier, then they walked away. I think they were concerned about what regulators would think. I like the company overall. I think it's a good tech firm. They're deeply involved with marketing and customer relationship management. But on the other side, this is a pretty challenging environment. So we got to see what the market gives us. But either way, I think this one could move pretty significantly if we get a continuation of this uptrend channel that it's been in. This is a weekly chart for about 2 years, or if we have a bigger breakdown. And then let's take a look at Dominion. Dominion is one I'd like to get long in again, but I need to see a bit of a pullback here. So I'm wondering if we get a pullback back to this primary trend channel, is that going to be a good buying opportunity? Well, if this trend line is defended and we get a bit of a reversal, that's exactly where I'd want to start building my position in this one. And this is a company that is serving a lot of data centers in the Northern Virginia corridor. That's the busiest area of the country and really the world for data centers. So there's tons of demand for power. In fact, the backlog has them now out 7 years. It used to be 4 years. So there's just tons of future business coming online. And it's also a safer part of the market to look at when the market is under some pressure. Now, traders are pricing in almost 240 bips of cuts by the Fed from now through September of 2025. I think that's a bit much. I think that gives us an opportunity near term to potentially fade the 2-year note into the Fed decision. And then after the Fed decision, get long, because right now it's overestimating what the Fed's resolve will likely be. And that gives me the opportunity to go into next week's Fed decision and see the potential for the Fed to come out with their SEP with the dot plot and suggest that indeed the market has it a bit wrong, that maybe we won't see quite this many rate cuts in that period of time. If correct, then we should have a modest pullback in the twos that gives us an opportunity to buy in for the cutting cycle, which should be an opportunity to both get capital appreciation and, depending on how one's positioned, also get paid a decent dividend or a decent yield over that period of time. So with the 2-year, I see this as a two-way trade, initially a fade into Fed Nest Day next week, and then a long if we get a dip from that. And looking at gold so far, it's continuing to consolidate near all-time highs. It's defended that uptrend line so far, so good. But I do think going into next week, it's going to be important to be cautious here. Typically, Fed week is not good for precious metals. So I'm still in a holding pattern on gold. I think we can get to 3,000 by the first half of next year. I still think we can get to 2,600 this month, but I want to get through the Fed decision first before we really start to see how this plays out, because gold's coiling up for a larger move. It could really be in either direction at this point. Breaking below 25.23 has me looking more bearish, and then breaking above 25.60 has me looking for new all-time highs and about $40 of upside to 2,600 in the near term. Copper is still in a longer-term uptrend, but I would say that I'm not really interested in longs until we get above 422, and I'd like to see that on a closing basis. That's really the next low volume node decision zone, and sort of the top of it, as you can see, it's also going back, but in an area of both supply and demand. So I would like to see this break above decisively. Then I think we could get some real more upside momentum in copper. A lot of it's going to have to do with China as well. They're the world's biggest consumer of copper, and their economy has not been doing so well. The U.S. dollar is starting to do what we talked about it potentially doing yesterday. We saw that big move higher today. I think we're set for that to continue into next week, but I would be cautious around Fed Day, because if the Fed doesn't necessarily come out and be a little more hawkish than what market expectations imply, this could fade right back to 100.5 pretty quickly. All right, folks. Well, we'll wrap it up there. Thanks for everyone tuning in and being a part of the Trader Aid community. I will catch you next week, Monday at 5 p.m. Same place, same time. Have a great night and a great week ahead.